Ladies and gentlemen, good day and welcome to the Tata Motors 4Q and FY20 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Yogesh Agarwal. Thank you, and over to you, Mr. Agarwal.
Thank you so much. Good evening, everyone. On behalf of HSBC Securities, I welcome you all for the Tata Motors quarterly results conference call. I'm very happy to introduce the Tata management team today. We have with us Mr. Guntur Buschek, MD and CEO, Professor Dr. Ralph Speth, CEO JLR, Mr. P.B. Balaji, Group CFO, Mr. Adrian Mardell, CFO JLR, Mr. Girish Wagh, PV Business Head, and Mr. Shailesh Chandra, PV and Electric Vehicle Business Head, along with other members of the Investor Relations team. Thanks again to the management team for taking time out today. We will start the session with some comments from the management, followed by Q&A. Over to you, Balaji.
Thanks, Yogesh. Firstly, once again, thanks all of you for taking the time to join the session. I hope all of you are safe and sound along with your family and loved ones. So without further ado, you already have the press release as well as the investor deck with you. So we'll try and take out the specific slides that you'd want to emphasize and thereafter leave it open for questions to the maximum extent possible. Prakash, can you move to the next slide? The standard safe harbor statement, nothing new here. Other than a call out that we have tried to calculate the impact of COVID-19 on our numbers, and those are analytical purposes using our best estimates. That's the only call out that I have additional to what we normally have. Keep moving. Okay. So key highlights of the year, it's been an action-packed year from a product and product offensive as well as technology offensive perspective. In India, I think the entire range got ready for BS6 and transitioned smoothly to BS6. Then, of course, there was an exciting Tata Altroz launch that happened. Nexon EV was unveiled in December last year. And from a JLR perspective, the most exciting launch of the year in the form of a new Defender, as well as the Discovery Sport that got launched into China. And the PHEV versions of Evoque and Discovery Sport also came through. And we unveiled the Vector Mobility concept earlier this year. And apart from the product launches, which are quite intensive, going to the next slide, we also had a series of management actions that we have been taking. First was the whole Charge Plus delivery, moving Charge to Charge Plus, and now stepping up that number to now 5 billion, which is what we are now calling out, having delivered 3.5 billion. And of course, the collaboration with BMW that we called out in our investor day. And the software over the air was announced along with the Defender launch, including the new infotainment module. On the balance sheet side, we talked about the promoter equity support through a preferential allotment happened in this financial year. And of course, in March, we called out the subsidiarization of the PV business, which has been approved by the board. And of course, from one of the smoothest transitions into BS6 with negligible inventory as we entered, despite COVID coming in at the most inappropriate time for the transition. All these have been delivered. In terms of financials, sorry, go back a slide, please. You've already seen these numbers. Let me just call out the key things that stand out. On a full year basis, we were near EBIT break-even despite a 23% drop in volume and a revenue down almost 14%. And EBIT was at minus 0.2%. And the profit before tax and before exceptional items was 7,700 crores. The exceptional item being the 2,500 crores charge that we have taken for asset write-downs and other provisions in the PV business. And the call-out that we would like to make is that despite all these challenges, second half of the year was positive free cash flows. Even this quarter was a neutral free cash flow despite all the challenges that we see. So a combination of what started looking as a solid second quarter and third quarter performance coming in from JLR and continued issues in India due to a variety of factors did get offset quite significantly by COVID as the quarter ended. And of course, the big ones in India being the medium and heavy commercial vehicles decline and the stock corrections that we did. So not been a great year, despite promising 2 quarters that came through. Next slide. You've seen it, combinations of the reasons for what happened. The call out here is, I think, from a volume and mix perspective, that's probably the entire story of why the decline happened. And contributions from JLR was about 4% down. The biggest contribution coming from Tata Motors standalone, dropping almost 8% in the total 13% decline that you saw. The retails, of course, being higher than wholesales in India by almost 65,000 units by the time the year ended. The next one. The EBIT walk you've already seen. The good news is JLR, despite all its challenges, increased its EBIT by about 50 bps, while almost the entire fall can be explained by the drop in the TML standalone numbers for reasons we have talked about many times in the past. Going on to slide 8, this is how the debt is actually laid out. We ended the quarter with a 42,000 crores of net automotive debt, and then add on top of it a 6,000 crores of lease payments, which is basically IFRS 16, a combination of those two becoming 48,000 crores. But it is backed with strong liquidity both in JLR and in TML, JLR at 5.6 billion pounds, and Tata Motors standalone at 6,700 crores. And these debt maturities are well spread out. So the liquidity remains strong and the debt maturities are well spread out, is a key call out in this slide. And even as we end May and look into June, the liquidity position continues to remain adequate as we look into the business coming out of the lockdown. So a few set of slides on the actions, corporate actions that is out there. As far as JLR is concerned, the key call out I'm making here is the charge plus delivery is now being increased to 5 billion, an increase of 1.5 billion over what we delivered in the 18 months to FY20. CapEx is being rationalized quite substantially by 40% to 2.5 billion in FY21. And FY22 plans are being recalibrated. I'll give you the context in the subsequent slide. Similarly, in India, the CapEx is being rationalized by a significant 56%, 1,500 crores in FY21, and FY22 again being recalibrated. And India again is calling out a structural cash and cost out plan of 6,000 crores of cash improvements that has been launched, including 1,500 crores of cost savings is being called out. These are pretty sizable interventions to reduce the cash burn, both in JLR and in India, given the fact that the demand situation has been is quite volatile and likely to be subdued for a while. Moving to the actions that we are taking on the PV business, and just pulling out all the actions that are coming together to make PV win sustainably. First, of course, is a call out of reimagining PV in order to rejuvenate the front-end sales and service. And I'm going to ask Shailesh to talk about it in his section. We also have a full, the most refreshed range of cars that Tata Motors ever had. And therefore, this we will try and drive salience and customer preference of this fully refreshed BS6 range. We called out in March a separate legal entity in order we can make this business a long-term value creation entity. And this will drive transparent capital allocation and focus within the business. And we are now building an efficient cost base as well. You recollect we already worked significantly in improving the contribution margins of the business. We'll step it up even further and reduce fixed costs further in this business to reduce break even. And along those lines, we are taking an exceptional charge for rationalizing the asset base and other provisions of about 2,500 crores in this business in India. And the aim of this business, we are now making it explicit, is to become cash positive by FY23 through all these steps that have been laid out in front of you. On the corporate actions front, again, a series of call-outs that we are making. Number one, a question that keeps coming again and again, the Tata Motors Group is a flagship of the Tatas, and it enjoys full promoter support. And we are now calling a significant intervention in terms of change of strategy to significantly deleverage this business, the entire Tata Motors Group. And starting point of it is all the cash intervention that we talked about. And JLR will also, along with that, will be JLR becoming sustainably cash positive from FY22 onwards while becoming future ready. These are big calls that are being taken to ensure that this business remains sustainably cash accretive in the long run, and would love to leave this with you in terms of how we are thinking about the business strategy going forward. So let me now hand this over to Adrian, who can walk you through the JLR numbers. Adrian, over to you.
Many thanks, Balaji. Good evening, everybody. I'll just call out a few of these. Of course, our first year loss before exceptional items in tax was 393 million loss, slightly worse than FY19. Of course, quarter four was devastated by the impact of COVID, and actually quarter four loss was 494 million. And that was 763 million worse than the previous quarter four in FY19. You all know that our Q2 and our Q3 results were much stronger than prior year, and I think that starts to indicate how much impact COVID actually had in the final quarter. We were headed for a pre-COVID quarter four of just over 6% EBIT. On a full year basis, Balaji has mentioned, the EBIT margin did improve actually versus prior year, but 0.1% was a negative. EBITDA actually was a 0.5% improvement versus last year as well to 8.7%. We'll talk charge later, which is clearly the underpinning of a significant turnaround in Jaguar Land Rover over the last 18 months. Temporarily, of course, COVID has impacted that. On volumes, retails were down 12%, actually at 508.7k. Revenue was down 5% at just under 23 billion. Of course, we had a very, very weak Q4, just 110,000 retails in Q4, down more than 45,000 units on last year. Quarter four, of course, is always our strongest quarter. Market dynamics with the UK, it was significantly impacted. From a cash perspective, even after the impact of COVID, we were still cash positive in Q4, 225 million. Full year negative 702. We don't like that, but it was 553 million pounds better than the previous year, even after COVID. Our cash break even has now fallen below 500,000 wholesales. It was significantly higher than that before the charge program actually began. Next slide, if you would, please. Okay, so this is the retail call out, full year 20 by region. I think China's the one, of course, I'm going to land on. COVID did have a more significant impact in China in Q4 because we all know it started earlier in China from the Chinese New Year date. If you remember, we were trending more than 20% higher year over year in Q2 and Q3 in China. On a full year basis, so you see here, we were down 8.9%, which shows the extent of the fall off in February and March. But that was better than industry minus 16.6%. Wholesales, which excludes CJLR, were 476,000 units, 6.3% down. And from a wholesale revenue and therefore, of course, cash generation perspective, quarter four was the second weakest quarter of the fiscal year after Q1. It's normally by far the strongest quarter because of those market dynamics, including, of course, the biggest selling month in UK is in March. So a dramatic impact on volumes in quarter four. Next page, if you would, please. Okay, so this is retails by nameplate on full year data as well. Year over year by nameplate is shown at the side. Standout is the Evoque. Of course, the new Evoque, 25% up year over year, even after COVID. I-Pace was also up year over year, almost 40%, so that stand out as well for us, although the Q4, as I mentioned, retails were only 110,000 units. You can see the winners and losers on the right-hand side of the page there. Next slide, if you would, please. Here we go. Here's the profit bridge year over year before exceptional items. We've done this one. I'll remind you, last year we lost 358, 0.7% EBIT margin. Our actual loss for this year is the 393 before exceptional, 0.1. Well, just call out a few things. We've talked them mostly previously. China JV, we had a worse year, although we have stabilized the position actually in the JV, so you will see better results going forward and our JV business in China. The most difficult assessment we had to do at the end of the year was on variable marketing, of course. We did have too much dealer stock as we stopped retailing units towards the end of March. We ended up with more than 100,000 dealer inventory, which is about 25% higher at least than we'd wish to have. And our assessment's been around the incremental marketing support in this suppressed marketplace, obviously, to sell those cars into the market. That's significantly within that increase of net pricing you see there. We also actually have an impact in our US market on residual values. You know, substantially all of our US vehicles are sold on leases, which come back to us. And in April, particularly, the second-hand residual value market was very, very weak, low auction numbers as well. Although May has picked up, and we believe the assessment we made at the end of March is still appropriate, but we did book another $78 million at the end of March for those reductions in marketing support. Then the good stuff starts kicking in, some really good work in manufacturing on material costs, all the structural cost improvements under the charge program. We talked to them a lot before. I think we're really, really pleased they continued, obviously, on a full-year basis and through Q4, even though substantially these costs wouldn't have been impacted by COVID, of course. Exchange our bypass. To the right-hand side of this page, what we've attempted to do here is call out specific things that we know were directly as a result of COVID, about $599 million impact on the full-year basis. All happened over the last few weeks. And we'll just give a sense there where we were tracking just mid 2.4% EBIT, although there was a collapse in sterling as well over the last 2 weeks, and we've ignored that from that impact assessment. We can talk more about that going forward if we wish to do so. Next slide, please. Cash. Okay, so our cash full-year outflow was $702 million. That was $563 million better than FY19 there. $225 positive in Q4, already mentioned. Estimated impact right at the end of March on cash was about $760 million. We effectively didn't pass 16,000 plus units through to the marketplace. We were tracking very, very strong in the first 10 weeks of the quarter. In most of our markets, it was repeating the trend of earlier quarter 2 and quarter 3. So the price out of this is very, very straightforward for us to do. And the big news here is before COVID, we think we'd have been cash positive for FY20. That's really important. That really shows the turnaround and the reassessment we've had in the business, which is why we can confidently say post-COVID, we will get back on track and we will be cash positive in FY22, as Balaji has already said. Next slide, if you would, please. Okay, this is the investment. It's down significantly versus the previous year, 516 million, just under 3.3 billion pounds. And all areas have actually reduced. You know, over this period, as we've mentioned before, this hasn't been done by stopping significant programs. This has been done by diligence, efficiency, care over what you spend. There has also been some delays in the launches on Defender, but that car is ready to go once the dealers are ready to actually sell. So we're now in place. 516 million pounds lower on investment versus the previous year. That's the end of the financial update slides, I believe. Just check next page, if you would, please. Okay, quick look at other things happening to us. You know what? This has been an awful time for so many people. Jaguar Land Rover, sadly, have lost 3 of our employees to COVID. That's obviously the really awful side of this. The really good side of this, the response of people within this company, it really has brought out the good side of people. You can see here, we turned our 3D printing to 14,000 visors a week for the front line. We actually lent 362 cars to those services. Our employees went out to help, putting themselves at risk. The spirit of this place, the reason why I love this place, has been shown over the last several months of this sad affair. So that's what we've actually been doing in times when we've not been able to get back to work. Next slide, if you would, please. Okay, so what have we done to respond to COVID? Well, our response was really, really quick. The board of management at Jaguar Land Rover met more than 46 times from the end of March through to the end of May. 1 hour meetings, actions, decision-based, closure of plants very, very quickly because we knew that was happening and we knew we'd stopped retailing cars to the marketplace, and therefore we had to slow down production. Of course, health and safety of our employees have been paramount, and I'll talk about the restart at the moment. We had too much inventory at dealers because sales literally stopped. More than 40,000 retails didn't happen over the last few weeks of March, so managing down that inventory is really important. 89% of our retails are now fully or partly open, 58% of which are fully open. So thankfully, all of the retails across all of the regions are now opening up. We instigated rigorous cost controls and spending freezes. We call them internally as star chambers. We've ran 155 star chambers, cross-functional reviews of spend over the course of the period through to the end of May. You know, everything more than £25,000 was cross-reviewed with a 4 eyes check, and it's had a dramatic impact on the cost and spending leaving the business, and I'll show you the impacts it's starting to have on cash over this horrible period. Balaji has mentioned investment. We believe investment target range this year is around that 2.5 billion. We did put some investments on pause, and we'll be talking in Q2 at what point we'll be releasing those. We'll give you that information when we talk to you after the Q1 results. And we have actually, given plants were closed, of course, we have actually taken the benefit of the UK furlough scheme. At one point, more than 20,000 Jaguar Land Rover employees were on furlough at home, not actually working, even though a lot of those have now returned as we've started to rebuild cars. Next slide, if you would, please. Okay, so this is the stop and the restart policy on production. I won't go through them all. You can see them there. The only plant that hasn't yet started back is Castle Bromwich. Our inventory at Castle Bromwich was higher at the end of March because that is a big selling season in the UK, particularly for those products. And you all know, I think, that the UK and the European regions have opened up slower than China and North America, and therefore the sales rate on those products will be lower. This is a demand-led production recovery, and that plant will be closed until the point in time when our dealer inventories are reduced. On the right-hand side, you see the statistics of an 89% there. Next slide, if you would, please. Okay, China. So you see here, I think optically on the left-hand side, what you could determine a classic V shape for China. The sales actually from the end of March recovered very, very quickly, and you can see there we're now at the end of May more than 4% higher than May 2019, which I'm not sure many people were predicting just a few short weeks ago. All of our showrooms are open, leads are strong, closure rates are better, not many casual shoppers. Most people are coming into the dealership are seriously looking to buy vehicles, so we're very, very pleased of the return we've had in China. Of course, we can't predict what's going to happen going forward, but this certainly 2 to 3 months after the Chinese market started to open up, this is very encouraging position for us. Next slide, please. I think this is the beautiful Defender coming up. Oh, no, it isn't. Sorry. That must be afterwards. Recovery by region. This is also important. Okay, I've talked about China on the left-hand side. North America is starting to show a version of a V as well. Our year over year in May for North America was 32% lower than last year. We were predicting a little bit worse than that. And so obviously we're looking at that data closely in June. You can see what I was saying on UK, bearing in mind, you know, that March number fell away dramatically over the last 12 days. We pretty much stopped selling. That's really sales through to about the 19th of March. You can see all of the dealers were closed. Some of them started to open up in May time, and we're watching the data very carefully in June, and the first 12 days were actually quite strong. Europe, exactly the same story, but more dealers were open depending on market, and overseas as well is generally following a pattern similar to Europe, although the volumes are a bit less. You can see the absolute numbers, 24,000 in May. June will be bigger. So we're steadily, cautiously improving our demand levels. Next page, if you would, please. This is the one. Beautiful Defender. Okay, not launched at the dealers, but you can see the start of sales date at the bottom there. UK and Europe have started. We already have more than 22,000 orders. We've actually put on pause the Defender 90 because we're making sure that the 110 actually gets an appropriate launch. 1.6 million configurations we actually had, complete configurations of this vehicle. It's certainly unprecedented in the history of Jaguar Land Rover. Just shows the amazing interest that we have had. We will open up the Defender 90, the shorter wheelbase, later in Q2, and we still believe this is a really promising start, even though, of course, it's been interrupted, and we're really, really hopeful for what this great vehicle is going to do. It's just an amazing drive. Next slide, please. Okay, Evoque and Discovery Sport. The data here clearly has been more impacted. Of course, it really depends on where these are sold. These are heavily sold in UK and Europe, as you would know, and those are the regions most impacted by closures, and therefore, not surprisingly, this is the data that's most impacted negatively year over year. Not much else to say. We just have to watch carefully as we go through the balance of the year. I do expect June to be much better. As I mentioned, both UK and, in fact, Europe has started strongly in the first 2 weeks of June. So we will have better results June year over year, but it will still be negative versus last year. The new PHEVs, of course, are in both of those vehicles from 21 model year. Next, please. Charge. Move to Charge Plus. Really strong quarter. Again, it really wasn't influenced by COVID. This was all done by the time it started to impact. Investments were lower, working capital, big working capital gain year over year. We did hit the £1 billion profit target, which I know a few of you were interested in, as you thought we had a slow start in the first half of the year. We did say, please watch, please wait, please be patient, and we've actually delivered the results. You've seen it in the bridge as well. The really positive thing is the results that come from across the total business, and as a result of which, Balaji mentioned, we're increasing the target to $5 billion, and I really feel good about that target. Actually, wouldn't surprise me if going forward we would increase it again in the second half of the year. Of course, COVID, we need to watch carefully. Next, please. You saw it earlier, the 4 to 5 billion on Balaji's stage. Don't need to see any more. Next, please. All right, give you a bit of indication because I know you're keen on, well, what type of program is it? We're basically now thinking about this as a 50-50 program. You know, investments will be low. We've signaled that. Inventory, one of the things we will do here is we will go again on inventory. We'll lean out our inventory. We'll lean out the dealer inventory. We'll bring it back down to a level even lower than the levels we had pre-COVID, and that's what we've got on the page here. And other savings, one-off savings like the furlough scheme from the UK government will bring up our one-time non-recurring cash benefits mostly to 750 million, we're saying here. We got plans for more than 750 million there. The other pieces, the sustainable pieces, the flow-through pieces, we got 3 very strong work streams now. Been working at them for a few months. Variable profit, net revenue improvements. Of course, the marketplace has been significantly disturbed, so you'll need to be patient with us on that one for maybe a quarter or so, but we've got clear plans. Material costs, we've signaled the Ignite program at the end of January. Those plans are in place, and we're now confident those reductions will start to come through once we bring our 21 model year cars in. Of course, a lot of this is change on vehicles, and we'll come along at change points to vehicles, the next of which is 21 model year. So as you will see that coming through as we go into the second half of this fiscal year. And finally, our overhead costs, our people reduction costs, as selling and general admin costs will be significantly lower, and that will be really the story on that right-hand side of the first half of this year, where our star chamber processes have kicked in and have had a dramatic impact, much bigger than the impact you would have seen previously. That's the 5 billion. You can talk to us on October what the new number is. I'm definitely confident that's going to grow. Next page, please. All right, funding. We've been able to get funding over this period of time as well. We did complete a deal with the syndicated banks in China last week. That's the full value, 5 billion renminbi over 3 years. We'll take Q&A on that. And we also completed early on in the process in April an extension for our fleet buyback in the UK, and that was worth 63 million as well. So through these difficult times, our network relationships and people who trust and believe in this company are still prepared to put money forward. That's the greatest sign I can give you for how we're trusted by this external environment. Next slide, please. Okay, looking ahead, Q1 will be significantly impacted by COVID. Of course, we've given you an indication of the cash positions. April and May, 1.5 billion cash outflow. That is actual data. It overwhelmingly is driven by one-time working capital unwind. We're not building cars. We're paying our suppliers off, and therefore working capital is unwinding on us. We think that's best part of 1.2 billion of that 1.5 billion, which tells you even when volumes are 50% of last year, the underlying cash loss over 2 months has only been 300 million pounds. That's how dramatic an impact we're having on this place. The outflow for FY21 Q1 is expected to be less than 2 billion pounds. And with 2 weeks to go, we're definitely on track to be lower than a 2 billion outflow in Q1. So let me repeat, we have not drawn down our RCF facility. Right? There is no need at this point in time for us to draw that facility down. Adequate liquidity is available with the new funds. Cash on hand, including the RCF, is £4.5 billion plus. Outlook, full-year performance outlook provided when we get better clarity going forward on what that demand is. It's a demand-led production and wholesale and revenue and cash generation. So it would be inappropriate for us to second-guess that with so much uncertainty still around pace of pickup in the marketplace, people coming into the dealers. We're driving free cash flows, though, from Q2 to Q4. That's the plan, and we expect to deliver on that plan. I think that may be my last slide. Just check. Next one, please.
Yeah.
Yep. Thank you.
Thanks, Adrian. Looking into the Tata Motors domestic business and the challenges we faced, call out would be in terms of the growth decline of almost 37%, in which the M&HCV declined almost 50%. EBITDA obviously getting impacted significantly because of this collapse in demand that we saw. And the system stock is now almost nil. So we don't have any dealer inventory in CV because the BS6 build-up was planned in the second half of the March, and we had the lockdown at that time. So looking forward to picking up that demand as and when it comes through. And PV also at an all-time low on BS6 inventory. Overall, I think from a profitability perspective, the exceptions I've already called out. And would also like to call out that even though overall free cash flow was trending well in March before the lockdown impacted, second half of the year, we are a positive cash, despite everything, the mayhem that you see in terms of numbers there. And moving on to the next slide. So we have actually have to summarize our performance. Just go back, Prakash, a minute. If I summarize the performance of Tata Motors, I think we are quite disappointed that despite the robust internal turnaround plans and actions that have delivered, we are unable to compensate for these shocks that are just coming one after the other, and look forward to more interventions from our end to navigate this crisis. Go forward. The profitability bridge, if you notice, almost it's entirely volume mix and pricing as the BS4 to BS6 migration was happening. And structural costs, they managed to keep it flat once you adjust for the depreciation and amortization of the whole BS6 investment that you see. And we do expect this to start trending down as we start cutting out capex in the coming years. As far as overall piece is concerned, the EBIT margin is more or less explained again by volume mix and net pricing. And the COVID impact for the quarter is almost about 500 crores. Go forward. On the free cash flow side, the good part of the free cash flow is the way the receivables and inventory has come down. But of course, the sad part of it is the whole operating cash flows not able to fund the investments that are out there. And that's one more reason why the call out on the capital reduction, particularly in a scenario where demand is not likely to be strong, has been done. And the COVID impact for the quarter is almost 2,000 crores because of collapse in payables and acceptances, very similar to what Adrian called out as well. Go forward. Investment spending, just go forward the same numbers, you've already seen it, rather than the call out that FY21 is restricted to 1,500 crores. And it will be fundamentally on regulatory spends and products that have already reached advanced stages of landing. And everything else will be kept in abeyance till we are able to see demand coming through and we are on our right to grow. Go forward. Market shares has been a good story for us on the key categories of medium and heavy commercial vehicles and intermediate light commercial vehicles. These are quite high shares that are coming back after a long period of time. So quite happy with that. At the same time, disappointed with the small commercial vehicle and pickup segment, where this is a volume segment, and therefore this does talk from a salience of the total category. This does have significant salience, and therefore that's the reason why the overall market share is being held. Clearly, plans are afoot with Girish can talk about in terms of how to pick this up, but it is good to see MNHCV and ILCV picking up, despite very, very clear focus that we're not focused on wholesale. We want to do the retail focus, and that's helping deliver sustainably. On the P&L of the CV business, move forward, Prakash. Overall, I think the EBITDA numbers just comfortably trends on double digits has definitely been impacted by the collapse in the business on the MNHCV side. And while we believe that while the inventory levels have all been well managed there, clearly the operating leverage hasn't kicked in at all, and that has clearly created the problem that you see here. Move forward. On the passenger vehicle side, despite shutting down the retail sales system under Concord, as well as the distribution arm, the wholesale market shares were held, and from a point of view of during the course of the year, retail market shares were in line with last year of roughly about 6%. And this is something that has helped us in terms of keeping our dealers interested in this and ensuring that they do not get into trouble with the BSA. But this is not good enough, and this is what Shailesh will talk about in his section. Move forward. And the profitability is fundamentally coming out of drop in operating leverage, as well as the inventory correction that we have done, all contributing to the drop in operating leverage. The good part is contribution margins are steady, in line with the turnaround plans already implemented. We now need volumes to kick in for this business to start picking up, and that's the brief that Shailesh is working towards. Move forward. And what is our response? Similar to what Adrian talked about in terms of the focus. From our side, the three clear imperatives in the India business. One is to secure growth, secure cost, and secure cash. On the secure growth side, I will leave it to Girish and Shailesh to talk about it briefly. On the cost side, we've clearly put out a plan to reduce 1,500 crores of costs in the Tata Motors system, both variable and fixed. And on the cash side, one is about the capex and working capital of a reduction of almost 4,500 crores, and also secure a funding of 4,000 crores, which are in final stages of closeout. That is the overall funding situation, which I'll talk about in a while. Just move forward. Let me hand it over to Girish, who's on the line, to talk about briefly the CV challenges that he's seeing in the market and how is he planning to step up customer engagement. Girish?
Well, thanks, Balaji. I think before I get into customer engagement, just a point of information on the market share. So as Balaji mentioned, we grew the market share in both medium and heavies and intermediate and light commercial vehicles. And you will recollect that this growth has now happened for second year in succession. And especially in medium and heavy commercial vehicles, we actually had grown the market share last in FY10. So, FY11 to FY18, there was a downtrend which was reversed last year, and this year we continue to grow. So that's how I think the market share in both medium and heavies and ILCVs have grown for 2 years in succession. Coming to this year, I think as we entered into, or we were exiting the last financial year, I think the COVID struck us. And the first thing which hit us was disruptions in the supply chain, especially where our material was coming from China and Europe, and then started the national lockdown in the last week. So the first step that we took was to develop a business continuity plan for ourselves. Then we also deployed this business continuity plan to all our channel partners, both in domestic market as well as international market. So this business continuity plan essentially focused on a few themes, 10 things essentially. So on employee safety, then social responsibility, cash conservation, cost reduction, and then also as we start getting back into the restart phase, how do we look at demand generation and demand fulfillment? So this business continuity plan has been a very good mechanism for us to keep the company on track as well as the channel partners on track, and all of them have found it to be very useful. Coming to the customer engagement, I think in this period, both the customers as well as our dealers have learned the digital way of engaging very well. And I can tell you that more than 1 million customers have been engaged during this period for two reasons. One is to explain to them the BS6 product range and also to start generating the pipeline. In addition to this, there has been a lot of engagement with the other stakeholders in the business, so be it financiers, bodybuilders, and so on and so forth. So this has also helped us to finalize all the financing schemes which are required for the BS6 vehicles, and in quite a few segments, we have been able to finalize the schemes in a manner that the equated monthly installment is equivalent to the BS4 EMI. So this gives a good lead for the customer. This year, we are also focusing on looking at the segments that are likely to grow or likely to show better growth as compared to the others. So we see a few segments which are coming up. The first one we see is, for example, tippers in medium and heavy commercial vehicles. And this is comparative to the cargo range of vehicles. We also see good demand coming in for the e-commerce segment, for petroleum, oil and lubricant segment, and also for segments like transportation of agricultural and dairy produce. So we are focusing on these micro segments and engaging with the customers to generate the demand, to generate pipeline. We also started seeding the BS6 vehicles for the initial lot of identified customers, which is a good thing. So retail of BS6 has already started. And we've also increased our focus on the non-vehicle business, or more so after-sales business. So here we see that more than 95% of our workshops across the country are open now. We also see that the job cards or the number of vehicles serviced in our workshops have approached very close to the pre-COVID level, which means that the workshop revenue for the dealerships are coming close to the earlier period, as also the spare parts revenue for us. In addition to this, used vehicle business is likely to go up this year, and that remains our focus area. Coming to the cost reduction and cash conservation, so Balaji has already spoken about it. So in cost reduction, we have actually repurposed our teams, mostly the engineering and operations team, to look at cost reduction. And this cost reduction program goes even beyond what we have been doing over the last 3 years. So this is focusing on direct material cost as well as all the variable and fixed conversion costs, and as well as other fixed costs. So significant targets have been taken across all the cost heads, and we have good plans for almost the entire amount that we have targeted. And for the rest of the plans, also we have good visibility to reach there as the teams work towards idea generation. In terms of production, I think we are working with strong guidelines for inventories as well as receivables. And also the capex has been reduced by a great extent as compared to the previous 2 years. So in previous 2 years, we have done bulk of our investments in the BS6 transition as also improving the product propositions. And now this year as well as next year, we are going to focus on some of the remaining BS6 products, the phase 2 ones, which we had intentionally decided for phase 2, as also preparing for the next set of regulations. So that's where we are focusing and have been able to cut down the capex very, very well. In terms of demand fulfillment, as you know, we have 5 plants in commercial vehicles. All the plants have started have become operational now. From 18th of May, we started the first plant, and 28th May, it was the last plant which started. And all the plants are functional now. We have around 30% of the manpower which is coming to the plants to start the production. So transition to BS6 has happened now, and we have started producing the BS6 vehicles. As a part of this, we are also tracking the suppliers ramp up. So we were tracking almost 1,000 supplier sites within the country to ensure a smooth ramp up. And I'm very happy to tell you that more than 95% of all these vendor sites have started working, which are required, which actually supply the material to us. And as a part of that, we are in a good stage now for ramping up our BS6 production. We are maintaining the social distancing measures within the plants, and the MHA guidelines have been converted into very clear standard operating procedures. So more than 100 standard operating procedures have been put in place, be it for our plants or channel partners. And there is also a strong audit mechanism to ensure that all these procedures are adhered to. During this entire period, we also looked at our social responsibility and support to the community, especially to the driver community. So we have ensured that the insurance policy that we were giving to our drivers, the medical insurance policy, also covers COVID testing and treatment now. Within our plant, we have continued to support all the temporary workforce as well as the local communities around the plant. And through our channel partners, a lot of support has been provided to drivers all across the country. Especially when the lockdown started, there were a lot of vehicles which were stranded, the drivers were stranded, and our channel partners have provided a lot of support to them during this entire period. So these are the actions which are in place in the buckets of demand generation. So we the start of the pipeline generation as the country comes out of lockdown. Demand fulfillment, I think we are ramping up our production for BS6 and we'll be in a position to supply the pipeline that we generate. And finally, I think a very strong focus on cost reduction and cash conservation actions also continue to ensure that we are absolutely on track. Balaji, back to you.
Yeah, thanks, Girish. Can we quickly move to the PV slides and I'll hand it to Shailesh on his plan? Shailesh?
Yeah, thank you, Balaji. So as far as PV business is concerned, as mentioned by Balaji, now we have a very strong product portfolio in place, which provides higher addressable market on the back of a completely new refreshed range. And this provides us an opportunity to reimagine the PV business and secure its future growth. So the approach would be to deliver on some key milestones in a very time-bound manner and with a very strong rigor of execution. And as you can see, these milestones are driving higher sales to achieve double-digit market share on the back of these strong products. We would be focusing on strengthening the operating cash flow, and here it would be through corrections in the variable, structural corrections in the variable cost and fixed cost. And of course, then expand and strengthen the product portfolio through the internal approvals and a potential partnership going ahead. So in order to support these milestones and drive systematic actions, we are going to focus on 6 key areas to reimagine the business and prepare it to be relevant and fiercely competitive in future. So the first one is reimagining sales, and we'll focus here on driving change and mindset towards retail. And we would direct the policies and work practices that drive this behavior, and also bring forth cohesive working between the Tata Motors sales team and the dealers, which should ensure better channel engagement as well as a very strong focus on the customer experience. The second one, which is reimagining the PV dealer process and resources. In this initiative, we are going to focus on driving twin objective of growth and network profitability by redefining the dealer systems and the HR practices to ensure that we don't compromise on the sales effectiveness. The third one is around reimagining the product delivery. And as I mentioned, we now have a very comprehensive and refreshed product portfolio in place. Now the focus of this initiative would be to ensure that an agile system and a team is in place that keeps the portfolio relevant, basically through timely and speedy interventions so that we keep the market excitement on as far as our portfolio is concerned. The next one is reimagining the PV digital transformation. As you know, digital is going to be the key source of differentiation and key interface in the new evolving customer journey. And we see that COVID has just accelerated the shift towards greater need of the customers to get an end-to-end immersive experience on digital platform. Therefore, digital transformation initiative is focused on delivering enhanced user experience, customer connect, and reach. The fifth one, which is reimagining PV after sales. Here, it is of great importance, I think, for the business, and we have the aspiration to be seen as a leader in after sales experience. We have covered some distance in this regard by being ranked number 2 in CSI for the last 3 years. But I think we definitely need to bring greater transformation to achieve our aspiration, and this specific initiative is going to focus on the same. Last but not the least, reimagining PV brand and marketing. Over the last few years, the new products that we have launched and the strategy of focusing on being new forever has actually helped us in establishing stronger connect with the personal segment customers and also relatively the younger customers. It gets reflected in the fact that our NPS score has been increasing over a period of time, and today it stands at around 25. And therefore, we need to continue working on enhancing our brand imagery to build very strong perception of the PV business in the market, which is very essential to drive the future growth. Apart from this, pretty much similar to what Girish mentioned about cost reduction initiative, there's a very steep reduction which we have planned for both, bringing structural improvements in variable cost as well as fixed costs. And the focus here is to take it to the next level of what we have been doing for the last 2 to 3 years, and we would take it to the next level by implementing new cost reduction levers, making the decision making faster, and also we have significantly increased in the last 2 months also the intensity of ideation workshops. So we are pretty confident that the stretch targets that we have taken as far as variable cost and fixed cost reduction is concerned gets delivered. So this is in summary, what we are planning to do as far as reimagining the PV business is concerned. Back to you, Balaji.
Thanks, Shailesh. Let me now move forward, Prakash. This we already covered, so let's move forward. I'll just get into the funding slide. At this point in time, we are in final stages of securing 4,000 crores of term funding. 1,000 already done, another 3,000 will be done this week itself. And we'll continue to evaluate other options at an appropriate time. And we believe, therefore, we are well placed from a funding perspective. Move forward. Tata Motors Finance, take a minute on that. It's a business that's now actually for implementing the strategy that we had called out assiduously, and it's going asset light. It's looking at its ROE improvement plan, and has, even though the disbursements have slowed down thanks to the market situation, continues to hold a steady market share of about 27%. And its asset light strategy meant that it has securitized or assigned more than 9,000 crores of assets. So we have sold down our assets. And the overall GNPA, we want to track it both on and off book so that the quality of the assets that we are managing is there. So that's about 5.1%. And most importantly, the cost to income ratio, which was about 67% last year, is now down to 51%. and it will go down further in the coming year as well. Sufficiently liquid, and we are not seeing any challenges with respect to it getting its monies that is needed. And this business has now delivered a PBT of 149 crores compared to 123 crores last year, an improvement despite the challenges that the NBFC market and the industry actually faced. Move forward. So last but not the least, I leave this looking ahead slide with you, calling out two things. One is, at this point in time, we will suspend the outlook till we get clarity on the demand. With the minimal revenues and both in JLR and here, we do expect Q1 to be significantly impacted. But we do expect to see a sustained improvement in cash flows from Q2 onwards as things pick up, and both in TML and in JLR. And therefore, the plan on with the very clear call out on deleveraging, which I called out earlier, and the focus on JLR getting cash positive next year and TML from cash positive from this year itself, we believe that we are on the right track. But obviously, the COVID crisis means that the level of challenge that all of us are dealing with has gone up multifold. That means we need to respond also with the same level of intensity. And we believe with the intervention that we have planned on cash and cost, on charge, on capex, and explicit call out on deleveraging, we believe we are moving in the right direction. And as and when we have further actions in this direction, we will share with you. But the theme of deleveraging is something that I'd want to leave you with as a takeout. With this, let me now hand you over the questions. Yogesh, over to you.
Thank you, Balaji. Okay, can we take questions now?
Yes, sure. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask questions, please press star and 1. The first question is from the line of Pramod Amte from CGS-CIMB. Please go ahead.
Yeah, hi. This is Pramod here. Two questions. One, with regard to the stimulus packages announced in the global car market, how do you view them as they are more inclined to EV, and how you feel JLR is positioned to benefit from the same?
Did you want to cover that one, Balaji?
Hi, Edwin. Yes, please go ahead.
I thought the first question, wasn't the first question on PV?
It's very difficult to understand the questions here, so we have problems to understand it. So.
Yeah, hi. If I can repeat, basically considering that there are stimulus packages being announced globally for reviving the car demand, what's your view on the same and how JLR is positioned to benefit from the same?
JLR stimulus. The stimulus package for what? Excuse me?
From the government.
For car demand revival in Europe and other countries.
Oh, the stimulus at the moment from the countries is quite different. In Europe, difficult to understand. You know, we were the very first one in introducing premium electric vehicles, and we have our I-Pace, the award-winning car. So in this kind of going green, we can maybe benefit. In addition, we have 6 PHEVs already in the marketplace, so we have a very, very young model line. So also in that context, I guess it will help. And I see in the UK still the discussion about the order of stimulus, so I cannot give you a clear picture about that.
Sure. Second question is with regard to the PV business. What's the interest you are looking at or a timeline for bringing a partner into the PV business? And how should we look at those milestones? Thanks.
Yeah, apologies. I didn't realize my phone had gone into mute after I finished, so I couldn't respond earlier. So the partner, I think we are in conversations with various OEMs, and multiple levels of interest is there in this. And at an appropriate time when we are finding the right partner, we'll definitely tell you. One of the reasons for the subsidiarization is also to enable us to get a right partner in the subsidiarized entity. And this is very much part of our plan to make PV sustainable over the long run.
Thanks and all the best.
Thank you. Next question is from the line of Pramod Kumar from Goldman Sachs. Please go ahead.
Yeah, thanks a lot for the opportunity, and sorry for your loss at JLR to COVID. My first question pertains to the debt covenants, Balaji, as in, is there any risk of any of the debt covenants across the group companies getting breached given what's happening with the financial performance? And also related to that is basically the existing financial support what you guys are getting from the UK government, and how much does it impact your ability to really right-size the UK operation given the substantial drop in volumes and substantial scale build-up outside of UK? So if you can address both of them, please. Thank you.
Yeah, I can confirm we don't have any financial covenants that are onerous or that get breached because of this. So those are well under control. As far as the UK government, the last one we had was a UK funding that happened, and that is something that we took it in October last year, and those have been well received and as part of the funding plan for the year. There's new ones, conversations as JLR has called out earlier as well. Conversations continue on a variety of areas, and as and when something fructifies, we will let you know. And I think from our plan, those are refinancing debt. They are not fresh debt because the overall deleveraging plan is basically being called out to ensure that we take down the levels of debt to more sustainable levels, and hence, as and when something fructifies, we'll share with you.
And any restrictions which come attached with these funding arrangement on your ability to right-size or shut one of the plants, anything like that?
The conversations happen in multiple forums on this, and we have said at this point in time, we will take the debt that we believe it's comfortable for us in terms of adhering to the requirements, our strategy as well. So still, I think these are still in discussion stages. If something fructifies, we will share with you.
And second question is on the JLR negative working capital. This is one of the few global companies which has got a negative working capital cycle. How sustainable it is given the headwinds what the dealer community is also facing and the shrinking volumes, right, and the increasing complexity of the business. So do you because that's a big source of capital for us in terms of cash flow generation. Sorry. What is the level of confidence on this being a sustainable practice, even say 2 to 3 or 5 years out from the management level?
So let's be clear about why the negative working capital is actually happening. It's happening because we stopped building vehicles in the third week of March for 7 weeks, and therefore we stopped bringing parts into our factories, and therefore we were paying suppliers for previous deliveries 2 months before, which we actually are now no longer building vehicles. It will reverse once our plants open, as they have. It will reverse once we start bringing parts into our factories, and it will reverse once demand. It will fully reverse once demand lifts towards pre-COVID levels. So it's purely as a result of settling supplier payments for the previous 6 to 8 weeks worth of production, and not actually building cars from the end of March through to the end of May. The restart process page we showed you showed that most of our plants began building again. We commenced in the 18th. Hello?
Adrian, apologies. My question was on the sustainability of the negative working capital model where you get the money from dealers upfront and you pay your vendors with a delay. How sustainable is this practice of getting the money from the dealers upfront? Because most of your global peers don't run a negative working capital cycle, wherein working capital is a source of cash flow. My question was pertaining to the sustainability of this in the longer term.
We work with funding partners within all of our regions. We've referenced North America, where we work with Chase. You know, that's a well-established model that we actually put in place just after we came out of Ford Motor Company 11 years ago in the Great Crisis. So that is incredibly sustainable as a model, and it will continue. And the working capital negative will reverse once we start building cars.
Fair enough.
Yeah.
Thanks a lot. Yeah, sorry, Balaji.
Sorry, I didn't have anything.
By the way, thanks a lot to Goldman Sachs. You increased the forecast. So I read it with really very interesting.
Thanks a lot. And best of luck. Thank you.
Thank you.
Thank you. Before we take the next question, we'd like to inform participants that in order that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have follow-up questions, we request you to rejoin the queue. The next question is from the line of Chirag Shah from Edelweiss. Please go ahead.
Thanks for the opportunity. Balaji, my first question pertains to a housekeeping one. On gross margins, we have seen across businesses in this quarter gross margins deteriorating, which essentially beat YOY. So any specific reasons for that? Is it more because of inventorization, or there has been pressure on commodities or pricing pressure also?
3 things that come to mind straight away. One, of course, is if I take the India business, the mix has been completely out of whack given medium and heavy commercials going down. So that has been a headwind against us. Then, of course, is VME both here and in JLR because of the BS6 migration, BS4 inventory being taken out, discounts in the market because of a stressed out market situation. And JLR, of course, Adrian did talk about the residual value impact coming from, let's say, an area like US. And third, of course, is given the entire China situation that we had during the course of the year, your mix from a geography perspective also works against you as far as JLR is concerned. And the combination of these mean that you do have a challenge on the contribution margin. And those are the things that we hope to reverse as we look ahead of it. Commodities per se, as we look into the future, no major inflation expected as far as just material. Yes, there will be here and then things there, particularly some of the more things like rhodium, platinum would be things that to watch out for. But barring that, no major commodity inflation coming up.
And the second question was on a comment made that in JLR, break-even levels have been brought to around 500,000 units. How much lower it can go by over the next 12 months, the break-even levels in JLR?
Adrian, would you want to pick that up?
Yeah, we're really struggling to hear the questions. I'm sorry that the line clearly isn't very clear. So could you repeat your question, please?
Yeah, let me actually, I think Chirag's line has got a problem. The question was at 500,000 units, cash break-evens have come down significantly to 500,000 units. How much further can it go down basis your experience was the question.
Well, it would be much lower in this fiscal year. So at least another 10% lower than that this fiscal year. But, my view is, once we actually reappraise what COVID means, we'll be better placed to actually respond to that question, right? But it certainly can and will be lower in FY21 than the 500,000 units, significantly lower.
Okay, thank you. Thank you very much.
Thank you. The next question is from the line of Sonal Gupta from UBS Securities.
Yeah, hi. Thanks for taking my question. Good evening, everyone. So one on JLR, just wanted to understand there seems to be a very sharp decline in average selling price per unit in this quarter versus previous quarter. So any exceptionals which are going in the revenue, I mean, in the VME, how big was the VME for this quarter?
Yeah, so there's two pieces impacting that. There's obviously in Q4, COVID actually impacted China more than other areas, and that's important to us. On a VME basis, we had 2 significant adjustments to make. One was a reappraisal on the marketing required to actually sell the 100,000 units that we actually had at the end of March. We booked about 2 percentage points increase in VME for that within the quarter. And the rest was, I think I referred to earlier about the incremental residual value risk we fed in, which was $78 million, which is just over a percentage point as a result of weakening of residuals and the auction prices in April and May, although they did actually strengthen in May. We think that $78 million incremental provision is about right. That was the latest estimate we did towards the end of May. They're the two big pieces within the quarter that dramatically impacted the net revenue.
Sure. Thanks. And Balaji, the other question I have is, what is your thinking in terms of raising further equity for the company? And what will drive that? So just want to understand, how do you see the funding requirement from an equity perspective?
I think two comments here. One, if you look at the internal plans for the business, very clearly looking at significant cash generation both in JLR and in TML going forward. And I think the trigger for this, and additionally a call out on deleverage has also been done. So I think the key trigger for this is to look at what is the level of demand, how fast is it coming, and basis that we will need to decide how do we ensure that the business remains in sustainable levels of debt. And at 48,000 crores and also the call out on the Q1 numbers, we believe definitely this debt is unsustainable. And therefore, the operational plans have been put in place. And then we believe that's good enough from a point of view of ensuring a level of cash generation that we can show the debts to start coming down. And then we'll need to look at other options subsequently. But the entire focus is to get the operational performance up and not just look at it from an equity perspective alone. But the issue is not a debt equity issue per se. It's about sustainability of debt per se and the interest covers that you need to operate with. And the demand shock is what we are watching, which if we believe that's going to get worse, then we'll need to think about it.
Okay, sir. Great. Thank you so much.
Thanks.
Thank you. The next question is from the line of Abhinay Singh from Morgan Stanley. Please go ahead.
Hi, team. Thanks for the opportunity. The first question is on China. We've, as the chart shows, we've started to see volume recovery. Could you comment a little bit about discounts in the market? How is the profitability of the China, and how do you see the profitability of China JV going ahead? That's the first question.
Okay, let me take that one before your next question. So think about China as two pieces of our business. One is an import model where most of our larger SUV5 units go. Actually, through this recovery period of April and May, transacting prices have increased, and therefore marketing support has been a little lower. So not only do we get a bounce back over year, we actually, the price that the customer was paying in the market was slightly higher, 1 to 2% more than in pre-COVID periods. From a JV model, we've done a lot of work as a team with the joint venture over the course of the end of 2019 calendar year. That was impacted by COVID. The plant actually was the first of our plants to close at the end of January, but we did actually introduce the Charge Plus program to the JV, and it was sponsored by our partner Chery as well. So we now believe we have actually reduced the break-even point in our China operations very, very close to the forecast volume for this year. So you will see improvements, and that's all areas, just like the Charge Plus program. So that's on manufacturing costs, that's on structural costs, that's on marketing costs, that's on material costs, and also net revenues. So we're working hard to increase the net prices for all of our vehicles. I think I'd mentioned before that 4 of the 5 nameplates have been refreshed over the previous 12 months. We took a lot of action to reduce the stocking levels, and that's all starting to come together. So I can confidently say on the track we're on, you will see year-over-year improvements from Q1 and going forward for our JV business.
Great. Thanks for that response. The second question is that
really looks positive.
Yeah, no, that's encouraging. The second question is, when we look at the charge plus plan for 2021, how dependent is it on underlying volumes, especially the sustained improvement target that you have for 750, or the other way around? What is your sort of underlying volume framework when you are setting out for this £1.5 billion pounds of savings?
Yeah, less based on volume than you might think. Of course, elements of the charge program, like our material cost, would be. If we take £1 out the car and produce 500,000 cars, it's more than we produce 450,000 cars, right? So there's a direct link on our material cost element of the program. But I did mention, I think earlier, that particular element of the program will kick in the second half of this fiscal year, where we do expect volumes to be higher. The other elements, warranty cost is a big piece of it. Much less volume dependent, actually, more about where we sell which cars and the energy we're now getting in speed of fix, which is dramatically improved over the course of the last 12 months, as well as the early signals that we're starting to see on 20 model year vehicles. They are definitely tracking better than the last 3 model years, particularly 18 and 19, which is the really great news here for us. Rules of the road do not allow us to start to show that until the vehicles become maturer. But at the end of Q1 and certainly Q2, if we continue on this track, we will see improvements on warranty cost performance. Parts and accessories will partly actually be impacted by volumes, of course, as you would expect. There is a link to volume there as well. Other elements like overheads, if anything, we have been more aggressive through the star chamber, so those structural costs will likely be lower in the first half of the year than they would otherwise have been, as we've constrained the organization in partial hibernation where we just haven't been building. So, it's a mixed bag, but the pieces that flow strongly will be the material cost piece, the parts and accessories, the warranty, and the elements of that structural cost piece. So, the program's really well balanced, actually, and I think you'll be quite impressed as we go forward in the quarters.
Great. Thanks. We look forward to that. Thanks.
Thank you. The next question is from the line of Atul Singh from Nomura Securities. Please go ahead.
Yeah, hi sir. This is Kapil. Thanks for the opportunity. Balaji, I wanted to know what is the sustainable level of capex that we should think about both the India and JLR business, and how much is the R&D and maintenance split for both?
Yeah, I'll let Adrian talk about the business on the JLR business. As far as India is concerned, I think the starting point of it is about what is the level of demand that is out there and what's the level of affordability that you can have. And obviously, one would want to ensure that the products are out there, but all these also require a demand on the other side. So at this point in time, it's a recalibration of the capex of 1,500 crores. All of it is capex. And this will have, bulk of the focus will be on regulatory compliance and the new products that we intend to launch. Not much as far as on-the-ground factory investments are concerned. Yes, they will be to the extent of tooling or jigs and fixtures and robots that need to be put in place. That's about it. But bulk of it will be all related to regulatory and products. As far as sustainability of it is that, I think it totally depends on what's the level of affordability that you have. And in a plan to deleverage, we will obviously look at all options, including partnership, to ensure that we are managing this in the right way. Yeah. Adrian, on the JLR side, do you want to pick it up?
Yeah, thank you. Well, we've given you the guidance on the 2.5 billion for this year. Just so you're clear on that, we do have some of our programs on pause. Obviously, the ability to actually work all the programs the way we're attempting to work is more difficult. So you should see, and you will expect to see, actually half one investment being lower proportionally than the second half of the year. We do expect to lift those pauses as we go through the course of Q2 into Q3, which is the 2.5 billion. I mean, and by the way, within that, just to repeat, there is no significant change or cancellation of any of our programs. Clearly, affordability and speed of development will be judged going forward. We will build our liquidity. That's most important. We are determined to be free cash flow positive, right? Within there's a level of affordable investment, and we will moderate for time without actually missing a drumbeat on the product. So we've given previously guidance of up to 4%. It will be lower than that. We'll come back later in the year once we've figured out speed of liquidity build and affordability and what that means for those programs on pause.
And Kapil, just to add to it, that is a precise reason why we are giving ourselves degrees of freedom with the interventions on cost and cash both here and in JLR. Because it's not sustainable to just you can't cut your way to prosperity. You'll need to grow your way to prosperity. And the cuts are more disciplined to ensure that we choose the right vehicles to invest in. So this is not the norm. This is more a way to ensure we survive the crisis. And then once we tighten the belts, get our processes right, nothing stops us from getting back on track again. But we need to acknowledge the external reality.
Yeah, fully appreciate that. Second, on Defender, we have 22,000 bookings. Are these retail bookings with deposits? And could you give some color, what kind of demand you're seeing there? I mean, monthly bookings or something?
Yeah, so these are dealer orders, just under half of which have already been pre-sold to customers. We're seeing quite a positive, as we often do in early part of the program, mix of those vehicles. It's proportionate across all of the regions. So, there's no one region any stronger than the others necessarily. So we got a good balance of those sales, a good mix of the sales across all regions. We've got more than 3 months forward cover. And bearing in mind, we haven't had one dealer launch yet. So we've really sold this off virtual events, with just the 120, and we've actually contained all orders on the 90. So it's a really, really very strong start. Clearly, we're in an unusual environment and an unpredictable environment. And again, I know I keep saying this, but we'll be much stronger placed in 3 months to be able to give you some direction you may be looking for from what we can expect from this product. But very excited over the first few months.
Great. Look forward to that. Thank you so much.
Thank you.
You should drive one. It's fantastic.
Thank you. The next question is from the line of Gaurav Khandelwal from Mirae Asset. Please go ahead.
Hi, team. Thank you for the opportunity. My first question is, I wanted to understand how well is the pension account in JLR funded? And the worry over here is with the decline in interest rate, is there a risk that you would have to invest one time in the pension account?
Do you want me to take that question? So
I'd love you to take that question. Thank you.
Okay, so because of the way rates moved at the end of March with many of the distortions in the market, we actually ended the year with a pension surplus of over £400 million. So I would say that was in part a result of unusual rates, particularly wide credit spreads at the time. And so as credit spreads have normalized, I would expect that we see the pension at this point in time.
Thanks. Good to hear that. And Balaji, any indication what kind of a funding you would need to invest in Tata Motors Finance?
None for the year. You will notice that I have gone in for an asset-light strategy and we are selling that down. And the debt-equity ratios measures all trending well, and therefore no plans to invest at this point in time. And they will be self-sufficient in their funding requirements by sourcing and selling down assets. We will go asset-light there. We're already at about 32,000 crores, and we will bring it all the way down to 23,000.
Okay, Balaji, last question from my side on the domestic business. So if I just draw a horizontal comparison on a quarter-on-quarter employee cost and other expenditures, I think both these expenditures have been very sticky in the standalone business from the last 8 quarters, particularly the employee cost. So and now your volumes because of exceptional reasons have been down or almost around 40-50%. But I mean, what gives you confidence that you will be able to, cut down your costs going forward? When in the last 2 years these costs have actually not reduced; they have only increased on an absolute basis.
We shouldn't forget there is a business that was growing at about almost 40%, U-turn and then drops to 37%. There is a lead time to navigate that kind of a fall that is there. And if you look at percentage turnover, 3 years in a row, that employee cost as percentage turnover was actually trending well down. And our entire focus in Tata Motors, if you recollect, I said it multiple times, was fixed costs have been tightly managed. Our intention was to go look at the variable cost and get it right. And now with the collapse in volumes of this magnitude and no sites coming through there, the current cost out plan will have all aspects of cost looking at it, including fixed costs. And therefore, those plans will be put in place to ensure that we reduce our break-even in a collapsed volume scenario. It's a question of focus that we are working on, and at that point in time, with the growth in volumes, you had one kind of an objective, and now with FY20 turning the way it did, you obviously have to correct for it going forward. And that's part of the plan for the year.
Thank you. Thanks a lot.
Yeah.
Thank you. Next question is from Sahil Kedia from Bank of America. Please go ahead.
Yeah, hi sir. I have a question for Balaji. Balaji, what happens to your hedging strategy in the forex side at JLR, considering that there's been such a sharp decline in volumes? How are you thinking about that? Because some of the hedges would have been taken before. So first, if you can kind of give your thoughts on that.
Yeah. I'm sure Ben is itching to go on this particular point, but let me just get the context and then hand it over to Ben as well. Hedging and the underlying go together. And as the volume starts coming off, we consistently keep reviewing our hedge position, and we do dial down, dial up, depending on the ranges that we operate under. So this is a dynamic process, and it is very similar to ordering inventory. We order hedges on that respect, and that's how we put it out and take it out depending on what is the external demand out there. So therefore, we do not expect any dramatic noise on the hedges because of this. Once you take underlying plus hedges together, which is what we have been consistently reporting, let me hand it over to Ben in case he would love to give more color to it than what I've given.
Yeah, the only thing I'd also mention is that we have been more, just because of all the uncertainty in the world, we have been more, with Brexit and otherwise, we have been more conservative about our hedging levels. So we went into this with lower hedge levels than perhaps we would have in the past to start with. It is the case that we've been dynamically monitoring the reduction in volumes, and we've been proactive in essentially closing out hedges as soon as we see any risk of over-hedging involved. And that hasn't involved any significant release of P&L as a result of those closeouts, just because of where the de-designated hedges have been relative to the hedging rates they were originally put on at.
Thank you. I have one more question. You guys have taken the advantage of the furlough from the UK government. Can you tell us what is the amount or what is the likely amount that you would have done, and what is the benefit that you've got? If you could just help us quantify that.
So we expect over the Q1 period a monthly amount to be close to £50 million. 20,000 people were furloughed at maximum. That is now reducing in June, of course. Now we have 13,000 people. If you use the 2,500 a person, you broadly get to the monthly amount.
All right. Thank you so much.
Thank you.
Before we go on to the next question, it's 8 o'clock now here, and we had the calls to be ending at this time. But given there's a fair number of questions in queue, and maybe the presentation overran a bit, happy to extend it by say 15 minutes if it works for all of you. and else happy to take it down here, depending on how each of your individual diaries are. So we are happy to stay here in case of further questions are coming up for the next 15 minutes.
Sure. Thank you very much. We take the next question from the line of Rakesh Jhunjhunwala from Rare Enterprises. Please go ahead.
Yes, sir. Good evening, sir, and I must laud your great fight back. My question is one on the electric car. Since your electric car IPs has got such a good response, what is the capacity we have to manufacture? How can it be scaled up?
Shailesh, can you pick this question up?
Balaji, this was regarding IPs.
No,
was this regarding IPs?
No, it's regarding
the Jaguar's electric car.
Oh, Jaguar I-Pace, huh?
Yeah.
Okay, Adrian, this is about Jaguar I-Pace capacities and ability to scale up further.
Yeah, well, it's more about battery supply, actually, I think, for us. So you see the volumes there within our FY20, 16,000 units. I think we referenced on several occasions, the demand ebbs and flows with different incentives from governments. Ralph mentioned that earlier. We have capacity to scale that number up based off the battery supply contracts we have, 30-40% relatively easily. So we don't see any upside misses or upside losses as a result of potentially scaling up as those government incentives shift going forward.
And is the gross contribution in this product as much as the other products?
I think the question is the gross contribution of this product as much as other products?
Well, the propulsion system, as you know, I think, is more expensive than other products. Where the market price holds up, you don't oversupply. It can be certainly, yes. We're learning what those supplies are, and they're changing very quickly on us because changes to government incentives. But as a base contribution, we actually make a considerable margin on it. Yeah, and don't forget, of course, it's also there as a strategy as a part of our CO2 compliance. Obviously, full BEV units are the most compliant units, and it's a part of our overall portfolio, which enables other sales and other nameplates as well. So there's two reasons. Obviously, the vehicle itself and the value we make on the vehicle, but also it aids our compliance strategy, which is so important to us.
How good is the demand? Hello?
How good is the demand?
Yeah.
Well, I think I've answered that. I think there's some upside capacity we could build should the demand be there, and the demand ebbs and flows really quite quickly depending on government's approach towards full BEV units.
Another question I have is, please. Hello?
Yeah, just to add, just from numbers perspective, if you look at the current year, the I-Pace sold about 15,000 units, and it is one of the growth drivers in terms of 1,500 units more than what it sold last year, and in these challenging times. So we believe there is opportunity here, and now with all the PHEVs and other electric options coming through in the cars, we believe this is something that's going to reduce the risk profile of the sales in JLR across markets across the board.
No, I'm talking from the point of view of price-earning ratio. But look at the way Tesla is valued. If you are selling an electric car, why should you also not be valued there? Another question I had is, can you give us the quantum of hedges that you have? To what percentage of, or what is the hedges? Because the pound has recovered very sharply against the dollar. So the question is that, what are you hedging your dollar revenue? And what are your open hedge? What is your hedges amounts?
Okay. Ben, would you want to pick this up in terms of your dollar revenues and the hedges that you have and your hedging rate, all of which is there in the update that you give?
I'm sorry. I apologize, Balaji. I couldn't quite understand the question. What's the question?
Yeah, the question is, what are the dollar volumes that we have? What are the dollar hedges in absolute that we maintain? and typical hedge ratios we operate
No,
under.
I know. I like to correct it. We make our accounts in pounds, so therefore we are hedging the pound against all currencies. Our revenue is finally recognized in pounds.
That's correct, sir.
Okay. So what is the quantum of hedge that we have, both on the supply side and on the sales side?
Correct. So when the question is, what is the revenue hedges we put in place?
And at what rate it has been hedged?
Correct. What are the revenue hedges and the rates at which we do it, and what are the pound rates and the supply rates and the hedges, particularly euro, and what is the rates we've done at?
Yeah, Balaji, that's a little bit too specific a question. I'll need to pull up the notional principle of the hedges and come back. I don't know if we could go to another question. I'll pull that information up and then we'll respond.
Yeah, can you just take this question in 2 minutes, sir? As he pulls his deck out.
Sure. And I must congratulate you all for your response. I mean, it's very good, and maybe things have hit us, but I think things will improve dramatically.
Thank you, sir. We'll come back to your point on this one once Ben pulls up. Just WhatsApp me once you're ready, yeah? In the meanwhile, go to the next question.
Sure.
Please.
Thank you, sir.
The next question is from Amin Tirani from CLSA.
Yes, hi. Thanks for the opportunity. My question was on, the fact that you have cut your capex significantly, especially in India, and you have taken write-downs also with respect to the passenger vehicle business. So what are the trade-offs which have been done in terms of future launches? Because part of the strategy for passenger vehicle business turnaround was new launches and improving gross margins. So how does that work going forward?
Okay, maybe Shailesh, you would want to pick this up as to how you are prioritizing your portfolio?
Yes, I will take it up, Balaji.
Sure.
So thanks for the question. I think there is going to be no compromise as far as some of the future launches are concerned, and that is pretty much on track. And the significant release of capex has come from the work which we have completed as far as the regulatory work was concerned. As you would have seen that at the start of the year, not only did we launch a new product like Altroz, but also took this transition from BS4 to BS6 to completely refresh and do, model cycle enhancement, mid-cycle enhancements also, with significant changes in the product styling, etc. So a lot of investment has been made already, and that allows us that we are able to bring down the capex for the time being. And there are new products which are also in the pipeline. This is something which we are continuing to invest on, and therefore there is going to be no significant compromise as far as our future product plan is concerned. Of course, as we improve our profitability, our cash generation from the business, that allows us more to strengthen and grow our portfolio even better. That is something which is a decision which we are going to take as we also come out of this very uncertain environment. And then we would also have to invest into the next set of regulatory changes which are going to come emanating from CAFE, as well as the BS6 phase 2 and RD. So I think we should be pretty much on track if everything goes as per the plan. So not major compromises is what we have made.
And just to amplify that point further, I think this is not the way it will happen forever. We need to be clear that at some point in time we need to get back into product creation mode, and we don't want to leave gaps in the portfolio because of that. But it is just enough cognizance of the collapse in demand for us to sometimes take this bitter pill of saying that let's just pause it a bit and get back to normalcy before we start again. We can't just keep burning cash.
Okay, that's helpful. Thanks for the opportunity.
Thank you.
Hey, Balaji, we can go back to that question if you want.
Sure, go for it, Ben. So, if you're there, then Ben, go for it,
yeah. So the outstanding value of our hedge book in terms of notional principal, and recognize that we're hedging out as far as 4 or 5 years on some currencies, is about 3 billion pounds on renminbi, about 8 billion pounds on dollar, and then on euro around 6 billion pounds equivalent, and then smaller amounts on some other currencies. So that's the amount of hedging. In general, we're hedging between 60 and 75% 1 year out, and then descending in 20% drops from there on beyond that. So, for example, we would be at 55% to 40% 2 years out. So that's the policy that we operate.
But what is the rate at which you are hedged?
Hang on 1 second. So, as an example, in this year, the hedge rate on the dollar portfolio is in the mid 130s, descending to the low 130s after this year. The hedge rate on the euros is around 113, 114 in FY21, and a little bit lower than that in the years further out, as an example.
And the renminbi and the Chinese currency?
The average on the renminbi, the average hedging rate is in the low 9s in FY21 and FY22. But I guess I'd just point out that in the renminbi, because the hedging market doesn't go out as far, we only hedge out 2 years on the renminbi.
Okay. Okay, so thank you.
Thank you, sir. I think we have time for maybe one last question before we wind down.
Sure. We take the last question from the line of Sriranjan from Antique Broking. Please go ahead.
Yeah, thanks for taking my question. My question is to Girish. You have, gained market share in last 2 years too. As you have said, it's around roughly 57% in MNCV and even ILCV. So what's the aspiration there? How do you look at it? Say we were at some point of time at around 60-65%. So that is our aspiration. And in the second part is on the BS6 products. How do you? Now the products probably even the competitor product, etc. Also. So how do you see? Are you confident of jacking up the market share again?
Right. So I think on the first question regarding market share, yes, I think we would like to continue with this trend. But it's very important to note that we have to take a balance between market share as well as the realizations. I think in the previous year, the realizations have taken a hit because of the inventory which got piled up when the market collapsed suddenly. So this year we have target to get both market share as well as realizations up. So that is the response to the first question. On the second question, I think we have done pretty well in terms of our BS6 range. So right almost 3 years back when we conceptualized these products, we were clear that we are not going to use this milestone as for just regulatory compliance, but actually deliver more value to the customer. And that kind of planning and conceptualization happened across the entire range. So we see almost entire range, we have better total cost of operation being delivered to the customer. In addition to that, we've also come out with a lot of value enhancers across the products, which is something that the customers were looking forward to. And we've also improved our performance across most important attributes that the customers value during the purchase decision making. So if you look at it, I think therefore we have a very good product range. We've also selected the technology most aptly depending upon the segment and the usage. So we have, for example, in medium and heavy commercial vehicles, 2 engines from Cummins, and one of them, of course, is the largest selling engine in the commercial vehicles globally. We've also used the technology expertise in after-treatment, both for their engines as well as some of our engines. So I think both from technology point of view as well as value proposition point of view, we are very well placed in the commercial vehicles and addressing the entire range. And with this, we will leverage this, dial up our communication to ensure that we gain market share across the segment.
Yeah, and just last, on the small commercial vehicle side, so how do you see the future? Because there are a couple of three-wheeler players who are also thinking that some of the products will not be available, so small commercial vehicle market will probably shrink. So we will be actually getting, three-wheeler will be gaining at the expense of four-wheeler small commercial vehicles. So what's your thought on that? And one more question to the passenger vehicle side. So how the products are ready? Most of the products we have filled the white spaces broadly, but in terms of features and all, we have seen in case of Harrier, we have launched many new features after after a year or so. So how do we see? So can we think of launching all the variants, all the features at the same time, so that we don't lose out in terms of the customers, which has happened particularly in Harrier?
Right. So let me take the first one. As far as small commercial vehicles are concerned, this segment will also degrow during this year as it did last year. But the rate at which it degrows is always less than that of medium and heavies and intermediate and light commercial vehicles. And that's the kind of trend we are seeing this year also. So the demand generation that I spoke about, I think the pipeline is heavier on small commercial vehicles as compared to the larger vehicles. That is number one. Number two, I think three-wheelers eating into small commercial vehicles, the actual trend that we see is exactly opposite, and I'm talking of the goods carrier segment. So over the past few years, actually customers have been moving up the ladder and moving more towards four-wheeler like an Ace, because that gives them better total cost of operation as well as better earnings during the month. And I strongly believe that, especially in BS6, with the kind of range that we have even in Ace, so starting from gasoline, which almost retains the BS4 pricing point, the CNG version as well as the diesel version, we have a very strong lineup. And in fact, we are actually poised to take away market from other three-wheelers. So we can challenge for the next question.
Yeah, sure. So I think it's a pertinent question as far as Harrier is concerned, but I must qualify that our attempt has always been to do a proper futuring study of what are the features which are going to be relevant 3-4 years from now whenever we develop a product, and try our best to ensure that those are incorporated in the product definition itself. We also, especially when we talk about Harrier, it is basically the option of automatic that we could not deliver, coinciding with the manual transmission, and therefore this had to go a bit delayed. But henceforth, as I said, that as a process, we would definitely, our attempt will always be to ensure that we are bringing comprehensive set of options, as well as all the features which are relevant in that particular segment. And if you recall, in the slide which I had presented, I also talked about the topic of a strong focus in product delivery, and this team is exactly going to focus on the same aspect, that even if there are certain features and options which are left out, we are able to speedily bring it to the market. But henceforth, the attempt would also be that our futuring study is robust, and we are able to coincide all the options and features all together in one launch that we do at any point in the year. So that would be the attempt. A pertinent point, I would say, can't deny that in Harrier we have missed that opportunity, but this would be our effort and endeavor going forward.
Sure. And lastly, on the
dealership
side.
My suggestion, just take it offline if need be. I think we are running behind here. We have to run into another call as well.
Sure.
Therefore, request if this can be taken offline, do come by Prakash. We'll be happy to answer it.
Sure.
So thanks everybody. Thanks all of you for staying on for another 20 minutes. Appreciate that and look forward to speaking to you soon. Stay safe and catch you soon. Take care. Bye-bye. Thanks all of you.
Thank you very much. On behalf of HSBC, that concludes this conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.